Good afternoon, everyone. Thank you for joining us for our session today. My name is Corey Donovan. I am the co-founder of Impact PHL. We are an impact investing advocacy organization here in the Philadelphia region, and we want everyone to know where their money sleeps at night and what it's doing. Today's topic has been quite popular. We have record registrations for this topic. We think the superpower of your DAF is the ability to do impact investing out of it. And our speakers are going to get very practical about what that looks like and how to do it. I'm going to drop, like I said, this topic's been pretty popular. Investor Circle did a webinar last week on this topic. And the Center for Sustainable Finance is doing a webinar later this week. So once I stop talking, I will put those links in the chat. If you're interested in doing a deeper dive or learning more or complementing what you learn here this afternoon. Before we go any further, I want to thank our sponsors. For anybody that's done ecosystem building work before, it can be notoriously hard to fund as you build the fibrous tissue for a thriving ecosystem. So I want to thank those who buy into our work and support our work because we wouldn't be able to do it without them. And before I turn things over to our moderator, I want to tell you about some upcoming sessions that we have. Again, Impact PHL Conversations is our webinar series, and I'm fairly confident that everybody on this call is getting older. So the question for each of you is how confident you feel that our economy and the systems we've built will help you age well. And if you're not so sure or you'd like to learn more about that, I'd like to invite you to join us for our next Impact PHL Conversations on September 22nd, Investing in the Future, ... of Aging. I'll throw that link in the chat as well. And then I also want to remind people that we will be recording this session here today. We record all of our webinars, and then we send you an email as a follow-up to this when it's ready for viewing. And then we also post them to the events page of our website. There's a calendar there. So if you digitally flip back on the calendar to prior months, you'll see the event page for those conversations, and you'll see a link, and you can see the topics there in front of you of what we did in prior months. Two quick reminders before I hand things over to our moderator. You will get that email when we wrap up here for the recording of this session, and it will be posted to our website. So if you want to share that out, hopefully that makes it easier. You can always come back to the website. And if you have questions, please drop those in the chat, and we'll be keeping an eye on that and feeding them to the moderator and the speaker. So with that, I'm going to turn things over to Dahna Goldstein, our moderator for today's conversation. Thanks again for joining us.
Thank you, Corey, and good afternoon, everyone. When most people think about a donor-advised fund, they think about the giving facet of it. You put money into a DAF, you get the tax deduction, and then over time you recommend grants to organizations you care about. But there's an important part of the story that we're not talking about as much, and where we think that there's real potential. And what is that question is, what is that money doing in the meantime? There is roughly $330 billion sitting in donor-advised funds today. $330 billion. These dollars were put into DAFs because the donor wanted to support social good. But your DAF isn't sitting in a vault. It's invested somewhere. And depending on your DAF provider, it may be invested primarily in public equities or other conventional investments, and potentially including in companies or in industries that are contributing to the problems that you're trying to solve through your philanthropy. So today we're going to ask a different question. What if that corpus itself could be part of your social impact strategy? How can we use DAF capital not to make grants, but to make investments that advance a mission, whether that's a loan to a mission-driven company, an investment in an impact fund, capital into an impact startup, or other things? We're going to try to make this pretty focused on the practical pieces. What can you do? How does it work? Are there any catches? How do you talk to the important people in your life, whether it's your family, your advisors, intermediaries, and people who are involved in your philanthropy and in your investing? And most importantly, how do you actually get started? We're going to leave plenty of time for questions at the end, but feel free to ask them in the chat along the way. First, some introductions. I'm Dahna Goldstein. As Corey mentioned, I'm the managing partner of Halcyon Venture Partners. We're a seed stage fund investing in climate, in health, and in equity tech companies. We're big believers in early stage impact investing as an asset class. We're looking for companies that are creating social and environmental impact and leveraging market mechanisms to build scalable companies that deliver competitive financial returns. And we raised our most recent fund leveraging donor advised fund capital. So I'm happy to speak to that facet of things as well as somebody who has used the tool. I'm joined today by Robin Gibbs, the Chief Philanthropy Officer at Social Finance, and Ryan Pierce, Program Manager at Inspire Access. Robin, first to you. Please introduce yourself and give us a quick version of what Social Finance does and where you sit within this broader ecosystem.
Thanks, Dahna. Social Finance is a national nonprofit and registered investment advisor. We were founded in 2011, and much as the name suggests, we apply financial concepts to social problems with economic opportunity as our North Star. In the past 15 years, we've mobilized almost $600 million, and that manifests itself in solutions that strengthen communities, offer income generating ideas, and wealth management opportunities or wealth building opportunities. As an RIA, we manage funds and custom portfolios for individuals, family offices, donor advised funds, community foundations, and institutional foundations across the spectrum from grants to impact first investments. It's a pleasure to be here today, and thank you for organizing us.
I'm excited to dig further into this conversation. Ryan, over to you. A quick introduction. Tell us about Inspire Access and how you're working to mobilize DAF capital.
Well, first off, thank you, Dahna, and the entire Impact PHL community for having us here. My name is Ryan Pierce, and I serve as the program manager at Inspire Access. And our organization is a 501c3 nonprofit that has a distinct mission to support underrepresented founders and or entrepreneurs that are directly supporting underrepresented communities through their work. We deliver on our mission by providing a simple way for high net worth individuals, family offices, and foundations to invest in for-profit enterprises using dollars that are reserved for charity. So through our process, individuals or entities can direct philanthropic capital toward Inspire Access in the form of a donation. And then from there, we can convert that donation into either a non-dilutive grant into an enterprise or a dilutive investment into a company or a fund. And what's interesting is that any returns that are generated will flow back to the donor's originating DAF. And that's a large reason why I'm here speaking on the panel in front of you all here today. So really excited and happy to get into the weeds.
Fantastic. Well, let's dive in. I think it'll be really helpful to get quickly into examples because I think that's sort of where the rubber meets the road and where this really becomes real. So we've talked about the notion of investing DAF capital in one way or another, something other than grant making, but turning DAF capital into an impact investment. If somebody who's listening today has a DAF and has really only ever thought about it as a grant making account, what else could that money actually be doing? So let's take it first at a high level and then we'll get into specifics. And Robin, I'll toss it to you first.
Great. So Dahna, I love that framing. So many of us live in a binary world where we think all of our pools of capital, our savings accounts, our wealth management accounts, and our DAF are all there to maximize returns. And then on the other sort of side of the ledger, we give money away to try to make the world a better place. And in financial terms, actually a grant is a negative 100% return. But we believe, and I think you share this belief, that there are certain problems in the world that actually have an underlying business model that can power them. They may not be attracted by return maximizing investors, but there is still an underlying return mechanism. And I'll give you two examples because I think you're right. Let's go straight to some illustrations of this. Number one, childcare. Most childcare is supported either by governments in some countries or by charity. We actually believe that there's an underlying business model in childcare. Is it profitable? No. But is there a profit mechanism? Yeah. Like, can you get a return plus return on a childcare investment? Yes. Is real estate one of the aspects of it? Yes. And so we've made a $3 million loan to a very interesting childcare REIT that is lending money to an organization that is purchasing up single family homes and converting them into small childcare facilities. And there are a couple of dimensions of impact in this. Number one, we're opening up hundreds of new seats for children to go to safe, and effective early childhood centers. Number two, we're providing entrepreneurial opportunities of wealth building for mostly female, mostly diverse entrepreneurs. And at the highest level, we actually want to sell these homes onto the entrepreneurs. So after several years, there's a rent to buy component. So it kind of meets all of our criteria in terms of driving economic opportunity through impact first investing. You can make this investment directly through your DAF, through the Impact First Fund, or directly with the Care REIT. And the money will come back after the loan period, and then you can power another loan or make another investment or grant it out eventually.
That's an incredible example. Ryan, over to you.
Yeah, just to build on what Robin was stating, you have a lot of capabilities with your DAF. You can not just grant to nonprofit organizations, but you could also direct capital toward small businesses, startups, and investment funds. On the Inspire Access side of things, we pride ourselves in enabling for donors to have complete agency with regard to the types of asset classes that they would like to invest in, provided that they do due diligence in the front end and feel comfortable with the terms of that investment. There are a number of examples that I could pull from. For anyone here inside of the DMV, there was a great company called Made on Market. It's a restaurant here in DC that was able to secure philanthropic capital from a donor before launching another location inside of Los Angeles. Very local type of restaurant that has a strong community appeal that an individual wanted to support using their DAF funds, and we were able to facilitate that transaction. We also have the capability to operate across private credit, venture capital, and hedge funds. There's a really great organization called Daintree Capital that provides working capital loans. They have received over $600,000 from Inspire Access by way of donors that they've brought to the table, and have since use those dollars to deploy into women-based CPG companies, women-based software companies that are creating jobs and opportunities across the entire United States. And I think the last thing that I'll close with is Inspire Access providing a way for individuals to dip their toe into new asset classes that they previously didn't get a chance to do. There's a family office that we have a great relationship with that has a DAF, and they wanted to use their DAF capital to kick off a more philanthropic impact investing journey, right? And they crafted a thesis around supporting women-based fund managers. And they brought one fund manager to the table inside of the VC space. We facilitated that transaction, but they were looking for other opportunities. And it just so happened that we had a great relationship with a women-led hedge fund based out of South Carolina. They hadn't done any investments in that space before. They brought in, some experts, and they did their diligence. And then from there, invested inside of a woman-based hedge fund that's generating great returns that has since been flown back to their DAFs. So there are a multitude of capabilities that DAFs hold, and there are different providers that can help you, achieve those goals.
I'd love to dig into just a few more examples to just keep making this as concrete as possible. Yeah. One of the things that I find interesting, both about the different organizations, but also about the range of impact investing in general, but impact investing that's possible with philanthropic capital, is that it can be everything from we're chasing financial returns that are going to be as high as possible on a risk-adjusted basis. We're making really risky investments, whether it's in an early stage company, an early stage fund. We're investing in a hedge fund at one end of the spectrum to the other end of the spectrum. This is impact first. What we really care about. It's not the negative 100 return, and I love that framing that a grant is you are losing 100% of that money for a good reason. Yeah. But so the impact first is just a different way of thinking about balancing risk, return, and impact. So I'd love to just dig into a couple more examples of how each of your organizations are kind of coming up with that perfect balance for your donors of risk, financial return, impact return. And Robin, if we can go back to you.
Yeah. So first, let's just align on what impact first means. It means that we are making a financial investment. There is a return expected. Some people think about this as compounding philanthropy or money back philanthropy. Some people call it catalytic investing. It's a little different than that, but impact first means that we're making a financial investment. It could be a loan. It could be private debt. It could be real estate. It could be venture equity. It could sometimes be a letter of credit, but we expect the money back. In most instances, we are looking for a principal plus return, but there are also instances where we're getting 60 cents on the dollar, and still that's better than negative 100% return. And that's a conversation that we have very clearly with our investors at the outset before we put them into a fund or something that we're investing in. And then as we think about some examples, I mean, we've recently made an investment in a company called Rasa Legal. This is an equity investment. So this is higher risk, but potentially much higher return. This is to address the 30 million Americans who have criminal records that are eligible for expungement. So there are many more Americans who have criminal records that are not eligible for expungement, but these are ones where people, essentially there's a financial barrier, an education barrier that stands in between somebody who has an old criminal record and them getting a better job, living in a better address, having better custody arrangements with their kids. And so this is a AI legal intervention that has now helped thousands of people clear their criminal records and move to a path of much better economic opportunity. So we made an equity investment. It depends on what the growth trajectory is of this company, what the ultimate return is going to be. It's pretty high risk, but we think that the impact so far outweighs the potential risk of this equity investment that it's worth it, and it's perfectly suited for donor advised fund assets.
Brian, go ahead.
Yeah, I think it's important to note the different players that exist within the venture, philanthropy, impact investing landscape and ecosystem. With organizations like Social Finance, they specialize in curated approaches for donor investors, whereas Inspire Access is better positioned to serve as a capital mobilizer or facilitator of investments. So donors that come to us typically have already done due diligence on different opportunities and are aware of the risks that are associated with early stage investing. However, for those that are just getting started on their journey and may have an issue area in mind, there are instances where we are able to spotlight different impact related opportunities for them to consider as they pursue moving forward with their impact investing journeys. A situation that comes to mind involves a private family foundation based here inside of the DMV. Their family generated their wealth through real estate, and they wanted to support women fund managers. And they didn't really know where to start. We kicked off an initiative known as the Inspire Highlights. We spotlight experienced fund managers that have institutional investors that have done diligence and are leading the rounds for those respective funds that they are supporting. So we provided them with general materials that was given to us by others that have invested inside of the company. We provided a high-level write-up, and we provided them with the information that they needed to do the research, bring in outside counsel if they wanted to conduct more thorough due diligence and move forward. And what happened was that foundation ended up supporting a New York-based women venture capital fund that is changing the way food sustainability is crafted inside of the United States, and it addresses food systems and food deserts and things of that nature. Naming specifically companies that support logistics around the development of food and the transportation of food and how it transports to different communities. So that's an example of different ways that we've been able to support people that are looking to kick off their journeys. But as we think about the return profile and how people manage returns versus impact, in short, it's up to the donor on how they want to deal with that with organizations like Inspire Access or Realize Impact, for example. I'll close out with two other quick examples, but we mobilized an investment inside of a company based out of Washington, D.C. that enables for municipalities to gain direct feedback from their constituents to see which programs that are being affected, that are effective and actually serving the people. Really, really interesting company. And we had a donor that ended up making an equity-based investment by way of SAFE through our vehicle into that company. That type of investment, we're looking at a 5 to 10 year return horizon if that return even materializes. And the donor is aware of that. That's just par for the course with venture investing. However, there are certain deals where we're able to support convertible note type of transactions where there are distributions that are made back to a donor investor. If they reach a certain maturity date or that debt is converted into equity. So the return horizon is a little bit different. There's a company that we've supported called Keep Company that works with workplaces and does great things as it relates to enabling for companies to, connect with their employees and create better benefit packages to retain their talent. We had 2 donor investors invest by way of convertible note into that company, and Keep Company was able to provide a 100% principal return plus profit on top of that. to all of the donor investors from there. So the return profile entirely depends on the terms of the specific investment and can vary. But to round things out, for organizations like Inspire Access, the donor is responsible for towing the line between impact and returns, and we're here to facilitate.
Yeah. Ryan, I absolutely love those examples. And I'll just sort of place sort of a bow around it, which is that what you're talking about doing and what you do with your investors is so exciting, and what many of us aspire to do. Social finance does some of that, but then we also have something called the Social Finance Impact First Fund. We name things very literally at Social Finance, like our name and our products. And the Impact First Fund actually would be akin to what you've talked about. Some family offices are able to do on their own because they have their own in-house diligence, lawyers, accountants, all of that. So we've taken that burden away from families, away from a donor advised fund, and offer people sort of a learn by doing, an easy on ramp, a diversified fund, professionally managed, best ideas. And to come back to Dahna's good initial question, in our fund, we're seeking to balance return, liquidity, and impact. And so for the Social Finance Impact First Fund, which is available on the Fidelity DAF platform and a handful of others, I've seen a couple of people write in that they're on their Fidelity account holders. It's a 5-year lockup. It's continuously offered, and it gives you a principal plus expected return with very significant impact and economic opportunity at the core of it, manifesting itself across several of those ideas that I've mentioned and more that we can go into in the future.
I just want to put a pin in one thing that you both have alluded to, which is that, with different risk profiles, with different return profiles, with different return horizons, there is an expectation that there is going to be some return of capital, and whether that is an appreciated return, whether it's 60 cents on the dollar, depending on where the investment is kind of on the spectrum, there is an expectation that that money will come back. This is probably obvious, but just to make it obvious to people on the webinar, once dollars or philanthropic dollars, once they have been granted or given or donated to a donor advised fund, they remain philanthropic dollars. So there isn't a scenario where that appreciation is going back to the donor as income, but it can go back to the donor, back into the donor advised fund, or into their account at Inspire Access or Social Finance or any number of the other players in the space to be re-granted, to be redonated, to be invested. Part of what I find compelling about all of this, and then I'll frame it as a question, is that it really multiplies the opportunities for impact. So at the end of the day, once there's a return of capital, the donor can say, sure, I want to grant this to my favorite nonprofit that's aligned with my social impact priorities, or they can keep investing. So it is this kind of continuous opportunity for impact. And I guess I'm curious, how do you think about, would you advise donors or investors to think about the possibility of creating essentially an evergreen pool of capital that they can keep using for impact?
Mm-hmm. Would you like me to go first?
Please.
Okay. So I love what you just said, Dahna, in terms of this concept of compounding philanthropy. And so the way we think about this evergreen component of a donor advised fund that is compounding the impact of the account and complementing in many ways the grant making that already is happening is to start with 10%. A 10% allocation is where many of our partners begin with, whether they're doing a direct investment themselves with Inspire or one of our other peers, or investing in a fund. And then they think about, as I said a few minutes ago, what type of return spectrum they want. If they have an ongoing commitment to a museum or a hospital that they know that there are going to be pledge payments that are due in the future, then they might have to manage the capital return accordingly. But ideally, we're looking to encourage people to allocate a certain percent of their money continuously to impact first investing.
If I can jump in with a quick comment, I just saw something come through in the chat, and I'm not sure if this is what this person was getting at, but the comment was that the money is not so much donated as parked. And I think that's exactly what we're trying to get at. And Ryan, your colleague Patrice has a wonderful phrase. She refers to the money that's sitting in DAFs as complacent capital. And I think what we're talking about here is the opportunity to take that $330 billion in what's currently complacent capital and put it to work in values-aligned ways that are generating impact returns, but also generating financial returns. Ryan, did you want to weigh in on the last question, or should I keep going?
Just to keep it quick, our process with Inspire Access is fairly streamlined. So any returns that are generated from investments will either be flown directed back to a donor's originating DAF, or they can hold an account with Inspire Access and mobilize additional investments into companies that are raising through our vehicle. But I think with regard to the question, what donors should think about, in the end, it comes down to the particular issue areas that you care about and or verticals. And then from there, determining the types of companies or funds that you want to support. There's a larger question on the proximity that you have to those opportunities and whether or not it makes sense to bring on specialists like social finance to help you kick off that journey, or if you just want to jump to the races and get started and work with a group like Realize Impact or Inspire Access. So I think overall, the really exciting thing about this space is that those returns can be recycled to continually compound impact. And there are multiple providers out there that can help you through your journey to do so.
Let's get into some of the nitty gritty of how all of this works. So let's say I have a DAF that's sitting with any of the big DAF sponsors, and I want to make my first impact investment. Ryan, what's the first step that I should take?
It's fairly streamlined with regard to Inspire Access. We've been able to right size everything to just three quick steps. The first step that a donor would need to take would be to fill out a donor agreement form with our team. You would connect with our team and fill out a form that stipulates that you would want to make a grant to Inspire Access that we would then use to invest into a company or a fund that you choose. From there, you would navigate your DAF sponsor platform. You would list Inspire Access's EIN number into the search portal. You would then find us and then render a non-restricted grant toward Inspire Access. From there, we would provide an acknowledgement form that says that we've received the funds, and we would proceed with investing inside of the company or fund on your behalf. Once we do so, we would loop you into any updates that we receive and direct any returns back to your DAF from there. So overall, we can complete transactions on average at around 2 weeks, but assuming everyone is checking their emails and there's not a whole lot of back and forth, we can wrap up transactions in around 4 days.
And Robin, what does that process look
Yeah.
like from social finance
So
perspective?
I'll talk about it for social finance, but then I'd also would love to just zoom out and have a conversation amongst the three of us in terms of how it works more broadly in the industry, because it's still a small industry, but it's very heterogeneous. And so for somebody that has a community foundation versus a DAF at NPT, it can be a bit different. And I'd love to sort of help workshop with people how they might go about doing that. So social finance, much like what Ryan said, it's pretty straightforward. We are on several dozen DAF platforms, and investors can make direct LP investments or recoverable grants into the Impact First Fund. And for any platform that we are not on, we can facilitate that, probably not in 2 weeks, but in not too much longer. And then just taking a step back in terms of what an investor might do to access any impact investments, and just to acknowledge Social Finance and Inspire are two great organizations doing cool work, but there are many of us in the field, and we're very happy to talk about others as well. If you have a donor advised fund, for instance, at the Boston Foundation actually has a dedicated Impact First portfolio that you can invest in your PBF DAF. And there are a lot of community foundations that do that. In fact, that's part of why many of us have donor advised fund at community foundations. Similarly, if you have an account at Fidelity or NPT or any of the impact oriented donor advised funds, you can partner with your philanthropic advisor there. They will have people on staff who can help you think through and screen through the ideas that they have on their platform. And then there are a whole myriad of ways that you can explore things that aren't on their platform that you can then either reach out to that organization or somehow engage either through CapShift or Impact Assets or one of these big gateway organizations that help facilitate impact first investments in DAF capital. Dahna, is that helpful?
It is, and I actually wonder if we can maybe take a step back and then we'll sort of go back into the weeds.
Yeah.
But there are different types of players, and we've alluded
Mm-hmm.
to a few of them. Ryan, could I ask you to just sort of give us the landscape of from DAF sponsors to intermediaries that are mobilizing capital to the nonprofit investment advisors and sort of across the spectrum? As I know we've tossed out a few names, but it would be helpful just to get a sense of the landscape.
Yeah, really glad that you asked, Dana. It feels as though it'll be difficult to really get in the weeds if we don't first identify the different players that make up the ecosystem. And as all of us here operate in this space day to day, we can get bogged down with jargon, but we just sometimes have to simplify. So happy to do so. Um, At a high level, there are a couple of different players that make up the venture philanthropy and or impact investing space that donors should be aware of. The first section would include DAF providers and or DAF sponsors. And there's really two tiers to this. DAF sponsors can be broken up into larger institutional-based DAF sponsor players, namely ones that are created by large asset management firms like Vanguard, Charitable, or Schwab, for example. And then the second tier of DAF provider would be a community foundation, for example. Now, a DAF provider is essentially a foundation or a nonprofit that enables for donors to create donor advised funds. They can park their money and then from there render grants toward causes and nonprofits that they care about. Now, different DAF sponsor platforms have different capabilities. There are some DAFs that enable for you to make investments directly from your account with them. There are others that prohibit impact investments from being made altogether. So with that being said, they just have their own respective processes that you would need to navigate. But there are there are external partners that can help streamline the process. Aside from the DAF provider area, there are capital mobilizing organizations. These are typically nonprofits that are compatible with large DAF sponsor platforms like Fidelity, Schwab, or even small community foundations that you could render grants toward. And then from there, they would use those funds to make non dilutive or recoverable grants into companies or investments into companies or funds on your behalf. There are a multitude of different groups that do this. Realize Impact is a great partner of Inspire Access that does a lot of great work in this space. There are groups like Catacap that also have capabilities to do this as well, and groups like Impact Assets that also have this capability, albeit they're a unique kind of situation, but I'll talk more about that later. And the last area I would say would be philanthropic advisors, right? So these are organizations that enable for donors to have expert counsel with regard to kicking off their impact investing journey. These are organizations that could be nonprofits. They could be foundations, but they typically have a suite of experts that help you kick off that journey. Some philanthropic advisors have their own in-house set of funds that you can invest in, ones that are generating consistent returns, that are generating real impact, that are vetted, and really good places to park your money. If you want to get a little bit more experimental, then there are other partners that you could leverage in order to scratch that itch, if you will. But the last thing that I'll say, there is overlap between some of these different organizations. There are some groups that kind of are hybrids, like Impact Assets, for example. Impact Assets is a DAF provider, so they enable for donors to create DAFs. They are also a capital mobilizer. They enable for donors to invest in and or grant into companies or funds as well. So all that being said, those are the three different buckets that make up the impact investing space. And sometimes there's overlap. It can get a little confusing. Just ask a friend and they'll make sure that you have what you need.
Yeah. And just to say, it's still a very small and nascent market. And so we're all just trying to build the tent to bring more people into doing this. At the highest level, our goal is that of the $330 billion of donor advised fund assets, 10% goes into it at some point in the future or more. And that would be mobilizing, $30 billion plus into these phenomenal social missions. And so please revert back to us. There's information on both of our websites in terms of the partners that we regularly work with, both DAFs and other intermediaries. And I'm always happy to share ideas of conferences and other convenings that are helpful.
There's a question that came through the chat that I'm going to jump on just because it directly relates to what you were just saying, Robin, and then we'll sort of pull things back.
Yeah.
On the mobilizing 10% and potentially mobilizing $30 billion, is there data so far showing whether impact investing through DAFs is actually expanding the total pool of capital that's available for social impact?
Absolutely. And actually, there was a report just a couple of weeks ago that many of us saw that Morgan Stanley did a survey of their donor advised fund clients. And while the percentage is relatively small right now, the interest is extremely high, as I remember it. And I think, Dahna, you and I were talking about this. I think it's about 92% of DAF holders are interested in doing impact first investing. And so that tells us that there's money on the sidelines and that they need more operators in between. They need their donor advised funds to make it easy enough for them to do it. And they need companies, whether they're offering direct investments like Inspire or funds like Social Finance, or even just the advice to think about how do I extend the impact of my grant making through beginning to make some investments in my donor advised fund.
I want to pull it back down to the specifics. What I've been hearing is there's a ton of interest, and we know that there's a ton of interest. There are a lot of opportunities. We've talked about some examples. And so let's say, I'm a DAF holder. I've decided I want to make my first impact investment. It sounds like my first step is to look at my DAF provider and say, what can I do on this platform? And maybe depending on who the provider is, there are options that are available to make impact investments that speak to what I want to do. But let's say there aren't. Let's say I've decided I want to make a particular type of investment, and my DAF's provider does not have an option for making that type of investment. And I'll kick it to Ryan first. What do I do in that scenario where I've looked at what's available on the platform, it doesn't meet where I want to start my impact investing through DAF journey? What's my first step?
Well, there are two paths you could take realistically. And it kind of harkens back to what we were talking about before with regard to the different players. If you have a particular opportunity in mind and you want to move forward, but your DAF sponsor platform just doesn't have the capabilities to support you, you could work with a group like Realize Impact or CataCap or Inspire Access, render an unrestricted grant by listing their EIN or searching for their partner nonprofits. And then from there, bring on an external party that can facilitate that transaction for you. If you need more support, and many donor investors typically do, that's when you can rope in maybe a social finance or a mission-driven finance to get more specialized support with regard to how you can kick off your philanthropic investment journey. So long story short, you could either bring in an external party to facilitate the impact investment opportunity, bring in an expert that can help you kick off that journey and facilitate, and or potentially even just try and render a grant and see if there's an opportunity to just grant the funds instead of making an investment from there.
Yeah. Those are such great points. I agree with everything Ryan said. And so essentially there are two pathways. So we're actually working with a new investor at NPT right now, and we have not facilitated an investment in it with NPT in the past. And there are two options. You can make a recoverable grant, and I saw some questions coming in about that, which is essentially just as the name suggests, a grant that is made to an organization. A tax deduction can be made if it's coming from an individual, or it goes out from the donor advised fund, is invested in the mission that Ryan and I have been talking about. And after a predetermined time, 5, 7, 10 years, it goes back into the donor advised fund. That typically does not require due diligence. That's almost like writing a grant. Making an LP investment typically requires due diligence if you're doing it from one of the major national DAFs or community foundations. And we've just gone through this process with NPT, and that's where we bring in an intermediary. So in the case of NPT, they would employ either CapShift or Mercer or one of the other third parties who would then do due diligence on social finance or mission-driven finance or whoever the organization is that is underwriting the impact investment. That will cost some money. It might cost several $1,000s. And then once that has been done, the donor advised fund holder can make an LP investment directly in the fund. And typically, as is the case with NPT, once one investor has done that, then other investors can essentially enjoy the benefits of the due diligence having been done, typically for some period of time, 6 months, 12 months, or something like that.
There are so many questions coming in that I think we may benefit from just kind of diving into the questions, and we can get back to our regularly scheduled program if we run out of questions, but I sort of have a feeling we may not. Can you talk a little bit about fee structures and get into specifics if you're so inclined? But I would imagine that part of what's behind the question is that once someone has donated money and it's sitting in a DAF account, there are already associated fees. So what is a way that somebody who's thinking about making an impact investment can think about fees for impact investing when they're already paying fees on their DAF?
You mind if I jump in first, Ryan? I've got a strong view. Okay. So,
Absolutely.
I just want to say, as someone that's worked in philanthropy for 30 years, it costs money to do anything well. And I just want to frame the conversation with that premise. We pay overhead costs at any large nonprofit organization because we want them to be able to employ good people as the service providers engaging with a community or a hospital or a community of any sort. So similarly, with impact first investing, it costs money to do it because it's doubly hard in some ways as doing a finance only investment because you've got to do due diligence twice. You've got to do the impact due diligence first. And if our impact due diligence doesn't clear our threshold, then we actually go pencils down. Then we do our financial due diligence. And on top of that, most of these entrepreneurs and fund managers are new, like they're new entrepreneurs. So they require a lot of support and focus from their investees. Now, to answer the specific question, it costs money. It typically costs between 1.5% to 2% to invest in an impact first investment of some sort, depending on what the structure is. I could say for social finance, our fund is a 1.5% fund. And when we talk about net returns, it's after fees and then also any fee that we would be incurring for the investments that we're making. Ryan, I'll hand that over to you now.
No, really, really helpful, Robin. For capital mobilizing organizations like Inspire, namely ones that don't provide due diligence or very low level reviews, of these different opportunities, there's a take on the transaction and there's a take on the return that's due. So for Inspire Access, the minimum check size that we're able to accommodate is 25K. On a 25K check, we would take 1% of the amount that's invested in the company or the fund, $250. And then from there, the entrepreneur would receive $24,750, right? So that's the upfront fee. The second fee that we charge is 1% on any gross returns that are due to a donor investor. So it's simple and plain, 1% in and 1% out. An important thing to note, and I just want to clarify in case it wasn't made clear before, not everyone's situation is the same. Although Inspire Access has the capability to support people that are just getting started with their journey, we're not performing specialized due diligence, and that's reflected in our fees. If you're working with someone that is doing that work, and that's reflected in the fee structure. So there are different players who do different things, and the pricing reflects that.
That makes a lot of sense. Can we dig a little bit into the role of community foundations and both how community foundations can facilitate this, what's currently possible at community foundations, if either of you has.
Yeah. So social finance works with community foundations across many, many US states. And we have designed impact first portfolios for several dozen of them, including the Boston Foundation. We're working on one with the Chattanooga Foundation, the Aspen Community Foundation, the Jackson Hole Community Foundation. And these are really, really exciting opportunities for donor advised fund holders of community foundations. Because as I said a few minutes ago, you are working with that community foundation instead of one of the big national players because you want to support your community. And what has been thrilling for us to see in partnering with community foundations is just how many extraordinary social entrepreneurs there are in these local catchments, in small communities like Jackson Hole, or in big cities like the Boston Foundation, and just how enthusiastic the donor advised fund holders have been in terms of following that. I'll share something very interesting that the Boston Foundation has recently implemented, which is an opt-out strategy. So for all Boston Foundation donor advised fund holders, they are allocated 1% a year up to 5% of their donor advised fund into the Boston Foundation place-based impact first portfolio. They have the option to opt out. But coming back to the point that you made a few minutes ago, Dahna, in terms of why is there so much money on the sidelines, sometimes it's just inertia. We all get a lot of emails. We all get a lot of solicitations. And so I am so inspired by what the Boston Foundation is doing in that they've actually found very few people don't want to invest in this portfolio. And it's a bit like being an organ donor. Like if you opt into it, then of course everybody wants to do it. Like why wouldn't we want to be an organ donor? Similarly, why wouldn't we, if we're an investor at the Boston Foundation, want to support their amazing work doing place-based investing in Boston?
I love that idea.
I think the one thing that I would add to that is very similar with Inspire Access, and we work with a number of community foundations as well. The one thing that excites us with community foundations is that they're incentivized and really excited to actually deploy the capital that they sit on into the community. So with that, presents a lot of opportunity for community-based engagements. When we work with community foundations, we simply offer a way for their DAF holders to activate their philanthropic capital into local organizations or companies that are within their network effectively. So again, although we don't provide a more bespoke type of approach to each individual donor, if there's an entrepreneur that they previously worked with, or someone that they advise, or a fund manager within their local community that's doing great work to deploy capital into other businesses, they can simply plug in with Inspire Access and then complete that transaction through us. So we're effectively an add-on for those community foundations and the DAF holders that they have.
Can we get into, we talked a little bit about fees. People who are DAF holders have, vastly varying amounts of capital in those DAFs. They may be coming from vastly different levels of wealth or, kind of available cash. Ryan, I know you mentioned that the minimum investment for Inspire Access is 25K, but is there a particular level of investment or donation where it makes sense to get started, or a level below which it does not? And kind of a corollary to that question is for investing in something like a fund, venture capital fund, or in a startup, there are accredited investor rules that the SEC has in place. So the kind of corollary question is, I don't want to say, does this get around accredited investor, but are there the same kind of accredited investor requirements for making these types of investments through DAFs?
I'll address the latter question and then I'll touch on your previous point. With Inspire Access being a 501c3 nonprofit that takes the position on the cap table, there's technically no need for the donors to actually be accredited in order to invest through our vehicle. However, given that we are mobilizing transactions into private investment opportunities, the minimum investment amounts typically supersede anything that a non-accredited investor would be able to do. So it's something that kind of cancels itself out and it ends up working around in a way that makes sense for everyone. But to your previous point, there's no particular amount that makes the most sense for donors. From an administrative standpoint, 25K versus 250K to 2.5 million is all the same to us in terms of what it takes to get that done. But one thing that we see donors do is, dip their toe into the pool, if you will, and maybe take 25K of 100K that's sitting inside of their DAF and then contribute that toward an emerging fund. And what's interesting is that we have the capability to operate similar to that of an SPV. So if there is a fund manager or a founder that has a minimum that's 250K, but they have multiple potential investors that can only contribute 25, they can each contribute toward Inspire Access, and we would still take one line item of the cap table and meet that 250K threshold, right? So there are different ways that donors can be crafty about getting allocation to different opportunities while remaining compliant and still generating impact as well as returns.
Yeah. And actually, this was a major focal point of the great conversation last week that DAF Commons organized. And so I'd encourage people who are looking at sort of participating in a group funded or a crowd funded impact first investment strategy to go back to some of the great recommendations that they made on that call, where donors, I think as small as a couple of $1,000s can pool together in a way that bypasses or gets through the accredited investor regulations, because you're doing it as a group and through an intermediary. And so there's some really exciting options for that.
Fantastic. What are just some of the biggest mistakes you see donors making when they dip their toes into this space?
Well, we've seen a lot of bruises from sometimes trying to go it on your own. And I think, we want to be careful here in that there are lots of people who do it on their own and it works very well. But a lot of the people that we see, and Ryan, I see you nodding your head, have tried to do it on their own. And as I said a few minutes ago, impact first investing is doubly hard because many of us think we know how to be investors. Many of us think we know how to be good philanthropists, but combining both of them is a process and a skill set all unto its own. At Social Finance, we've got 125 people, several dozen people focused on this, an internal legal and finance team that's helping us with all of this analysis. And so I think people have made mistakes in making investments directly without properly engaging perhaps a partner that can help them think through the diligence ramifications across the spectrum of impact and finance.
I think one thing that I would say to build on that It's not so much that these are mistakes that donors make because we'll catch them before it happens, but this is an emerging, ever evolving ecosystem. And I say that to say, from a compliance standpoint, from a legal standpoint, things are ever evolving and ever changing. And when we have donors that come to us with opportunities that we deem mission aligned and we're happy to work with, sometimes when we lift up the hood, we realize that there are challenges that are presented to us if we want to mobilize the transaction. For example, um, there can be conflicts of interest if you have a significant position inside of a fund or a company and then tack on your philanthropic capital from your DAF to reinvest in that same company. There are instances in which it can work, but if you have an over 35% position inside of a company, then it can trigger um, or breach the expressed benefit, requirement as deemed by the IRS, and it can be complicated, right? So there are times where we have donors that are super eager and gung ho to take everything inside of their existing venture portfolio and top up with their DAF capital, but we're not always able to mobilize those transactions because it could, create a compliance risk for the donor, and we don't want to do that, right? So if you have a majority position inside of a company or a fund, just to be mindful of that, and just make sure that you are careful in how you want to move forward. We can make it happen, and we're going to stop it before it becomes problematic, but just cross your T's and dot your I's and always talk to your accountant and your advisor.
Yeah.
One quick thing I want to flag, and this is advice that we give to fund. We're not investment advisors, but as we're talking to people about early stage impact investing, particularly individuals, people get very excited about angel investing, and I think there's amazing opportunities to mobilize DAF capital into very early stage, into those companies that are unproven and really needing that catalytic capital. But the advice that we always give folks is if you make one early stage investment, you are very likely to lose your money, and that early stage investing is a portfolio game.
Mm-hmm.
And obviously people have different priorities around return of capital versus generating impact, and both. But thinking about taking a portfolio approach to whatever the issue is that you care about, or whatever the issues are that you care about, mobilizing capital into more than one bet to be able to generate both the impact and the financial returns that you're looking for.
Dahna, it's such a great point. And so we think that an impact first portfolio should be in many ways treated just like a market rate portfolio in terms of diversification and risk management. And so let's sort of drill down. What if you have $100,000 DAF? Then you can put $10,000 into maybe two or three different crowd-funded impact first investments. If you have a $10 million DAF, then you can do $1 million investment that is in a diversified fund or 10 different $100,000 investments. And so that's often a good place to start, is if it's a smaller DAF, to think about joining forces with other emerging philanthropists. And if it's a bigger DAF, to then think about diversifying much the way you'd be diversifying your financial portfolio.
There's one question that's a little bit tangential, but I'm curious. It's a super interesting question. I'm curious if either of you has thoughts about where CDFIs fit in this world.
Yes, they are an absolutely essential component in any impact first strategy. And CDFIs are really the backbone, I think, of this whole movement, and have been around a lot longer than many impact first investors. So as a starting point, we invest in CDFIs, we partner with CDFIs, we expect them to help us build the field in impact first investment, and they are, for many impact first investors, the first port of call. And when you invest with a CDFI or you give a CDFI a loan, you're actually getting that. You're getting local exposure, and you're getting a diversified portfolio typically in the area that they are supporting, either regionally or thematically.
Fantastic.
Right. I would say the same for us. We are able to work with CDFIs and enable for donors to invest in CDFIs, whether it's CDFIs that specialize in working capital loans, or CDFIs that specialize more in affordable housing or things of that nature. It's a crucial aspect and a more de-risked space than supporting an early stage startup. You kind of have a double bottom line where you get the impact focus. We get the local focus, you get the impact upside, and you get the financial return upside as well.
All right, this has been a fantastic conversation. We're rapidly running out of time. I'm going to toss one question to both of you, and then I'll give a little wrap up and hand it back to Corey. Imagine, and hopefully everybody who's on this webinar is super inspired and wants to go out and do something. So imagine everybody logs off and takes one action with their DAF this week. What do you want that action to be? And Ryan, to you first.
Well, it's hard to just distill it down to one. But if I had to distill it down to one, I would say learn about the capabilities of your DAF. It's not one word, it's one sentence, but learn about the
Yeah.
capabilities of your DAF. And it really comes down to narrowing in on the issue areas and the sectors that you care about, thinking about whether or not you have proximity to vetted, legitimate opportunities in that space. And then from there, understanding what your DAF has the capability to do and what help that you need. Some people may just be ready to jump right into the pool and mobilize philanthropic capital, and that's where certain external partners like Inspire Access or Realize Impact makes sense. If you would like more tailored support, you should think about bringing on a philanthropic advising organization that can help you adjust risk and returns and do so in a way that is protected and led by experts. So
Yeah.
that's what I would say.
I will echo everything that Ryan said, even though that was more than one point. And I'll just summarize by saying, talk about it with one of your loved ones. Talk about it with your parents or your partner or your sibling who you think about these really important things with, and make a move forward. Dipping your toe. Oftentimes, the first investment is the hardest one, and then it gets easier, and you can learn by doing.
Fantastic. So I think the overall takeaway here is that not every dollar in a DAF should necessarily become a venture investment or an impact investment, but that we have an opportunity to be intentional about the capital that we've already set aside for social impact, and how we can really maximize both the impact and the returns and potentially create a pool of evergreen capital. So start by asking where your DAF is today. Ask your provider what options you have, find out what alternatives are. And then think about what will have the greatest alignment with your vision for what your money can be doing and the impact that you're hoping to have in the world. The money is already there. The question is what we're asking that money to do, and hopefully we've given you a good roadmap today to start to do more with that money. And Corey, I'm going to turn it back over to you to wrap us up.
Thanks, Dana. Thank you for putting this all together and moderating. I think Robin and Ryan would also echo that. You did a great job piecing this all together, and I think giving us something to sink our teeth into. Ryan and Robin, thank you for making yourselves available and sharing all your insights. I think you'll be popular in follow up in the following weeks if you haven't been already. Again, I think the purpose here is, there's already $330 billion in DAFs. I think I saw a number that said in the next decade, that's going to be 3 to 4 trillion. That's all money on the sideline, just hanging out, usually invested in those companies that aren't being thoughtful and intentional. So I think the question is, how do we mobilize that for doing good, whether it's grants or investing, but probably both. And so I think the final ask here before we disconnect is, like Dana said, let's talk about this. If you know folks that have capital, if they have DAFs, that's our goal here with Impact PHL is to get that money. I call it our collective financial horsepower aligned with the future we want to create. So thank you for your time. And again, we'll send this out via email for those of you that registered, and we'll make it available on our website. Thanks again, all of you, for your time.